Hey, this is Matt from InvestiQuant. Today is Monday, October 5th, 2020, and Friday was the non-farm payrolls report. We ended up gapping down sizably, amongst other news besides the non-farm payrolls report, and we pushed higher, ended up balancing out the majority of the day. But I thought what would be interesting to look at today is what has happened historically the day after the non-farm payrolls report when gapping up like we are currently trading this morning. So this morning we are trading higher on this Monday morning as we approach the open. So let me come into Discover. We'll look at all four instruments. The setup is based upon getting long at the open of regular trading hours, which is 9:30 a.m. Eastern Time, and exiting at the close of regular trading hours, which is 4:15 p.m. Eastern Time. For the opening filters, I'm simply going to say gapping up. I'm not sure if we're going to be gapping up above the prior day high or within the prior day range. At the time of this recording, we're kind of trading around that area, so it could go either way. But I'm going to assume that we are opening above the close from Friday. Then I'm going to go into the indicators section, and I'm going to put us in a like environment. And to do that, I'm going to say that we are above a 10-day simple moving average and above a 10-day simple moving average. And lastly, in the market events section, I'm going to say it is the day after the non-farm payrolls report. So in this section, you can test all of our different market events for the higher tiered market reports and events like options expiration day, that sort of thing. But you can also test the day before or the day after. So I'm going to come over to the far right-hand side to the active today section where I can just click on any of these things. I'm going to click day after non-farm payrolls report. That adds it up to the market events section. Then I can click view results. And here we go. So these are the results of going long at 9:30 a.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time, when opening above the prior day closing price on the day after non-farm payrolls report and above a 10 and 200-day moving average. So historically, we've got 54 samples in the S&P dating back to 2003, the NASDAQ 62 samples, the Dow 58 samples, and the Russell 48 samples. And historically, looking at win rates here, the S&P has ended up with what would be a green daily candlestick 57% of the time. The NASDAQ has been stronger 63% of the time. It has finished above its opening print. The Dow 66%, so that's the strongest of the group, and then the Russell 63% of the time it has closed above its opening print. So historically, the win rates on these have leaned to the bullish side. The S&P is the weakest at 57%. The Dow is the strongest at 66%. And if we look at the average win to average loss, looks like the average win quite a bit bigger than the average loss on the S&P. That is the case for the NASDAQ as well. The Dow is pretty similar in size for average win and average loss. And the Russell, the average win is just a little bit bigger than the average loss. So historically, it looks like the win rates have been a little bit favored, as well as the average win has been equal or bigger than the average loss in all four of these instruments. Let's take a look at the results distribution. So here are the results for the S&P. It looks like historically the most common result for the S&P on this day has been a small loser. And then after this loss, you can see the bars really drop off, and then there's not a whole lot going on the outlier over here towards the edges. There's no bars here on the histogram. We do have a handful of medium-sized losing days here. On the positive side, the most common scenario is a smallish winner, and then they start dropping off as well. But we do have some taller bars that reach out further to the right on the positive side. So a few more larger winning trades on the positive side. So hopefully you found that helpful. Good luck today, and we'll see you next time.